There is a country with the highest debt-to-GDP ratio ever recorded by any major economy in the history of modern finance. Its national debt is 260% of its annual economic output. Its government is spending more on servicing that debt than on anything else in its budget. Its currency has fallen to its weakest level in 3 decades. Its bond market, worth $7.3 trillion, briefly broke in January 2026, sending shockwaves through financial markets on 4 continents. And nobody outside of specialist financial circles is paying attention. That country is Japan, the world's 4th largest economy. A nation of 125 million people. A country so deeply integrated into the global financial system that what happens in Tokyo does not stay in Tokyo. Japan borrowed its way through a lost decade in the 1990s, a financial crisis in the 2000s, a catastrophic earthquake and nuclear disaster in 2011, and a global pandemic in 2020. Each crisis was met with more debt, more money printing, and more promises that growth would eventually arrive to repay it all. It has not. And in January 2026, the bond market, the market that funds the Japanese government, began to tell the truth. January 20th, 2026. Tokyo bond markets opened normally. By afternoon, traders were describing what they were seeing as pure chaos. The yield on Japan's 40-year government bond, one of the longest-dated bonds in the world, exploded above 4%. That was its highest level since the bond was first introduced in 2007, a level that broke a psychological barrier no one expected to see breached. The 30-year bond yield simultaneously jumped between 25 and 30 basis points in a single session, the largest single-day move in that maturity since at least 1999. Here is the detail that reveals the true fragility of Japan's bond market. This entire catastrophe was triggered by the sale of just $170 million in 30-year bonds and $110 million in 40-year bonds. A combined $280 million in trades, less than the value of a single block of Manhattan real estate, created $41 billion in bond market destruction in a single afternoon. This is what happens when a market is so bloated with debt, and so dependent on a single buyer that any deviation from the script triggers panic. The reverberations reached the United States within hours. US Treasury Secretary Scott Bessent made the extraordinary step of calling his Japanese counterpart directly, a signal typically reserved for emergency interventions. To understand how Japan arrived at this moment, you need to understand 30 years of monetary policy unlike anything the world had seen before. In the early 1990s, Japan's legendary economic boom, the one that had the world convinced Japan would overtake the United States, collapsed. Property prices crashed. Banks collapsed. Growth disappeared and never fully returned. Japan's response was the template for every central bank crisis response since: cut interest rates to zero. Buy government bonds to suppress yields. Run enormous fiscal deficits to stimulate growth. Japan introduced zero interest rate policy in 1999, the first major central bank to do so. When that failed to revive growth, Japan went further. In 2016, the Bank of Japan introduced negative interest rates, charging banks for the privilege of holding money, a policy so unconventional it was thought impossible outside of theory. The Bank of Japan introduced yield curve control, an explicit commitment to hold government bond yields at its chosen targets by buying unlimited quantities of bonds. For years it worked. Yields stayed low. The government could borrow cheaply. The debt grew. And grow it did. From 60% of GDP in 1991 to 100% by 2000, to 200% by 2010, to 260% by 2026. Every year of low rates and deficit spending added another layer to the pile, a pile that now dwarfs every other sovereign debt burden in the history of modern finance. The Bank of Japan has spent decades buying its own government's bonds, so many that it now owns more than half of the entire $7.3 trillion Japanese government bond market. This is an extraordinary concentration of ownership with no parallel in any other major economy. And it has created what financial analysts now call a mutually assured destruction dynamic. Here is the logic. If the Bank of Japan stops buying government bonds, as any central bank worried about inflation should do, Japanese bond yields will rise immediately and dramatically. At 260% debt to GDP, every percentage point increase in Japan's borrowing cost adds an enormous burden to an already overstretched budget. The government could quickly find itself unable to afford the interest on its own debt, a sovereign default scenario. But if the Bank of Japan continues buying bonds indefinitely, it is providing the fuel for the very fiscal irresponsibility that is creating the crisis. It is enabling the government to borrow more, at artificially low rates, expanding the debt that makes the situation more dangerous every year. The Bank of Japan cannot easily tighten policy. And it cannot easily continue loosening it. It is trapped, and the $7.3 trillion bond market it dominates is trapped with it. The only question is which side of the trap gives way first. The immediate trigger for the January 2026 bond market crisis was political. Prime Minister Sanae Takaichi called a snap election and announced a platform of aggressive fiscal expansion, tax cuts and increased government spending at exactly the moment when Japan's bond market was already under severe stress. The market's reaction was swift and brutal. Investors looked at a government with 260% debt to GDP announcing plans to borrow even more, and they sold bonds. The program became known as Sanaenomics, a play on Abenomics, the fiscal and monetary stimulus program of former Prime Minister Shinzo Abe that expanded Japan's debt dramatically through the 2010s. Japan's government approved a record 122.3 trillion yen budget for fiscal 2026, up 6.2% year-on-year, and the first budget to exceed 120 trillion yen. It was a record high for the second consecutive year. Debt servicing costs, the amount Japan must pay just to service its existing debt, increased 10.8% to 31.3 trillion yen in 2026. The first time this figure has surpassed 30 trillion yen. Japan is spending more on paying the interest on its existing debt than it has ever spent before, while simultaneously committing to spend even more. The bond market noticed. And it reacted. There is a hidden financial structure that connects Japan's bond crisis to every stock market and bond market in the world. It is called the yen carry trade, and its potential unwinding is what keeps global fund managers awake at night. Here is how it works. For 3 decades, Japanese interest rates were at or near zero. Investors could borrow in yen almost for free. They then converted those borrowed yen into dollars, euros, or rupees, and invested the proceeds in higher-yielding assets, American technology stocks, Indian equities, Indonesian government bonds, Australian real estate, Turkish currencies. The difference in interest rates, the carry, was essentially free profit. The estimated total size of this trade across all its forms is approximately $7 trillion. Now, as Japanese interest rates rise for the first time in a generation, the mathematics of the carry trade reverses. Yen borrowing becomes expensive. Investors must sell their global assets, the US tech stocks, the Indian equities, the Indonesian bonds, to buy yen back and repay their loans. In 2026 alone, Indian markets saw foreign portfolio investors pull more capital in the first 4 months than in the entire previous fiscal year, a direct consequence of yen carry trade unwinding. When the yen carry trade unwinds at scale, it is not a Japanese problem. It is a global liquidation event. Japan is the single largest foreign holder of US Treasury bonds. It owns $1.2 trillion in American government debt, more than China, more than any other nation on Earth. This holding is not just Japan's problem. It is America's problem. And in 2026, Japan began selling. In the first quarter of 2026 alone, Japan sold approximately $30 billion in US Treasuries, the fastest pace of selling in 4 years. The reason? The yen had weakened past the politically sensitive level of 160 to the dollar, triggering the need for currency intervention. To support the yen, Japan must sell dollar-denominated assets. Its primary dollar asset is US Treasuries. When Japan sells US Treasuries, American bond yields rise, because more supply in the market pushes prices down and yields up. Higher US Treasury yields mean higher borrowing costs for the US government, for American mortgage holders, for US corporations. The same dynamic played out in May 2026, when Japan and China together led a foreign retreat from US Treasuries as the Iran war raised currency pressures. China's Treasury holdings fell to an 18-year low. The two largest foreign holders of America's debt were selling simultaneously. What had been a quiet, gradual process became a visible concern, and a foretaste of what a full Japanese fiscal crisis could mean for American borrowing costs. Japan may be the epicenter of this crisis, but the shockwaves reach Asia's fastest-growing economies with surprising speed. The mechanism is the carry trade. As yen borrowing costs rise and the yen itself strengthens from its intervention lows, investors who borrowed in yen to invest in Asian assets must liquidate those positions. They sell first. They ask questions later. In India, foreign portfolio investors, many of whom had borrowed in yen to fund their Indian equity positions, pulled more capital from Indian stock markets in the first 4 months of 2026 than in the entire previous fiscal year. A full year's worth of outflows compressed into 4 months. In Southeast Asia, the dollar's strength relative to the yen creates its own pressure. ASEAN currencies weaken against the dollar as the carry trade unwinds. A weaker Thai baht, Indonesian rupiah, or Philippine peso makes imports more expensive, fuels domestic inflation, and forces central banks in the region to raise interest rates to defend their currencies, at exactly the moment their economies may be slowing from the knock-on effects of global trade disruption. Thailand, which is already navigating the aftershocks of US tariffs and the slowdown in Chinese demand, faces an additional headwind from a Japanese financial crisis it had no part in creating. The speed with which Japan's bond market turbulence spread to global markets in January 2026 was a demonstration of how interconnected the world's financial system has become. Within hours of the JGB crash on January 20th, the US 10-year Treasury yield surged nearly 6 basis points, a significant single-session move for the world's most liquid bond market. German 10-year bond yields jumped 2.8 basis points in the immediate aftermath. Emerging market bond markets sold off. Currency traders across Asia moved into defensive positions. The Federal Reserve took the extraordinary step of contacting currency traders, a signal that Washington was watching the situation with alarm, a step typically reserved for near-emergency circumstances. The deeper risk is not what happened in January. It is what a sustained Japanese fiscal crisis would do to global financial markets. Japan's bond market is the third largest in the world. Its carry trade funds global risk asset prices. Its treasury holdings anchor U.S. borrowing costs. If Japan is forced into a genuine debt restructuring, or if the Bank of Japan loses control of its yield curve and yields spike uncontrollably, the transmission to global markets would dwarf the 2008 financial crisis in its initial scale. The January 2026 event was not the crisis. It was the warning. Japan has 3 potential exits from its debt crisis, and none of them are clean. The first is genuine fiscal consolidation, cutting spending and raising taxes until the budget is balanced and the debt begins to shrink. Japan has been promising this for 30 years. It has never delivered it. The political cost of cutting the social programs of an aging society is too high for any government to bear. The second exit is a debt restructuring, a formal negotiation with bondholders to reduce the face value of Japan's debt. This would be the most catastrophic event in global bond markets since the Second World War. Pension funds across Japan, which hold massive quantities of government bonds, would suffer devastating losses. The yen would collapse. Global financial markets would face a crisis of confidence in sovereign debt everywhere. The third exit is inflation. If Japan allows its inflation rate to run hot, above its target for an extended period, it effectively reduces the real value of its debt over time. This is what governments throughout history have done when they cannot pay their debts honestly. It punishes savers. It destroys the purchasing power of the yen. And it pushes the cost of Japan's decades of borrowing onto the ordinary Japanese citizen who saved for retirement in yen-denominated assets. The IMF projects that Japan's fiscal deficit will widen in 2026, and that even under optimistic assumptions, Japan's debt-to-GDP ratio will start rising again from 2035. The January 2026 bond market crash was not the end of the story. It was the opening chapter,